We kick off a massive earnings week with United Parcel under the service. Now, in all honesty, this will probably be the worst earnings report we will see all week, and the headline does go to show that their shares slide on not just an earnings miss, but they've also cut their guidance. Now, unfortunately, to make matters even worse, they missed on both a profit and revenue, as we will shortly uncover, and we can see the revenue guidance that they did cut. It is down now for the full year, 93 billion. The market was expecting around 94.5. Now, what did the management say? Well, they believe this is down to two elements, a weak freight demand as well as soft pricing in this industry, and they do believe we have entered a global freight recession. Now, when we take a look at the earnings, exactly how bad it was, 179, and we can see that analysts were targeting 199, and the revenue they also missed, 21.8 billion, 22.18 was what was expected. On top of a double miss, they also, as we mentioned, have cut their full year guidance for revenue, so not the greatest news if you are a shareholder. Double miss, 93 billion now as the revenue as opposed to 94.5. And just to make things a little bit better for shareholders, although I do believe in the midst of this earnings it doesn't really make a difference, they have announced they are targeting around 500 million in share repurchase in 2024. Now, what has that done for the share price? Well, just today they are down around 12%. They are now trading at a new 52-week low. And whilst this hasn't updated yet as the market is just open, over the last 12 months, they are now down more than 30%. In terms of the ratings, well, we do get a double buy and a hold. Bear in mind now that this is just new information, so this may change. And when we do come to look at the updated yield, it is now sitting at a 5% yield. Could be attractive. Is it undervalued? Should we consider buying? What is going on? Let's find out today. And also the forward P will now also be sitting lower, so we will uncover that as well. Now, first thing to note, let's just take a look under the hood of this company and see what is going on with their metrics. Their dividend safety score, now it does sit at 69, so it does look to be safe. And as we mentioned, the yield now with the updated price does pretty much sit at around 5%, although do bear in mind just the more recent increase was very trivial at 0.6% this year, again just to keep their dividend streak moving. Now, it was reaffirmed a couple of months ago, their dividend safety score. What this effectively means is that a dividend cut is unlikely, but bear in mind, given this information, a double miss as well as a cut to their revenue guidance, this could ultimately change. Very quickly then, in the last recession, they did in fact maintain the dividend, the Great Recession 07-09. They didn't increase, they also didn't decrease, and we can also see they pretty much had average growth, negative 13%, when the S&P itself was around that level as well, and they marginally outperformed, negative 48 with the S&P, negative 55. Now, one thing we mentioned, very trivial increase just this year, but we can see over the last 5 and the last 20 years, they had previously increased the dividends at a double-digit rate. So let's find out whether or not we actually see this continuing with very trivial increases. And we do note 14 years of consecutive increases, 55 years of paying a dividend without a reduction. Now, what we always like to look at is dividend yield theory. Now, it does state a company is undervalued when the current yield sits above the 5-year average. So looking at this, you would say severe undervaluation, yield much higher than the 5-year average, and also the updated forward P sits at 14.4 with the 5-year at 16.6. So that is a double undervaluation signal, and we can make it a triple now as the industrial sector does sit much higher at 19.6. One thing to bear in mind though, we don't look at any of these models in isolation, and towards the end of the episode, we will take a look at the updated valuation to see if we do see a nice margin of safety and strong upside. Now, in terms of free cash flow payout, we definitely always focus on this. Earnings is susceptible to manipulation by management through accounting, and we can spot dividend cuts inbound looking at the free cash flow. Below 60% is our preference. Now, 2023, massive red flag indicator, something that you don't notice from the earnings. And what this effectively tells us that management paid out more in dividends than they generated in free cash flow. Now, look, they're expected the same over the next 12 months. So I would say with some degree of confidence, if things don't massively change, there will be a very trivial increase to the dividend in January 2025. In terms of the free cash flow per share, well, we can see it has increased over the long term, but very inconsistent. And on top of that, not just a revenue cut, as we mentioned, to the guidance, but also over the next 12 months, their free cash flow is expected to fall. In terms of sales growth, now we do notice it has increased around the 3 to 7% that we like to see year on year, but do notice in the more recent year they have cut their revenue -9%, and it will be interesting to see in 2024 if they will be able to turn this around into a positive. Also, speaking of their revenue, something that we have covered in previous episodes, they did recently win a contract with the USPS, essentially the United States Postal Service, from FedEx, and we will start to see this affecting their revenue from September 30th, and that is when essentially FedEx's contract expires. So something just to look out for when we do take a look over the next few quarters to see how it has affected their numbers. In terms of the total sales, then numerically speaking, they have nearly doubled their top line over the last 10 years, though we have noticed from 2022 it has come down, and the expectation, as we said, for the full year of FY24, 93 billion, so a very marginal increase from the prior year, and again, that is if they manage to hit that number, which they have now cut. In terms of ROIC, I quite like the metric here. I want to see 10% or more. Just give me faith management are able to effectively allocate their capital. It has been decreasing, but 20% in 23 is still fairly decent, but again, something to keep an eye on given the fact it has started to decrease. And when we look at the margins, it straddles around the minimum that we want to see. Not the greatest, not the worst. As always, in an ideal scenario, we want to see this increase over the longer term. Instead, it has been pretty much inconsistent, but around 1 or 2 percentage points different year on year. Free cash flow margin as well, straddling around the minimum we want to see, so nothing too much to report on that. Finally, with our metrics, the net debt to EBITDA, that is the earnings before the interest, tax, depreciation, amortization, we want to see below 3. Remember, the numbers below are the number of years it would take the company to pay off all of their debt net of cash on hand. And why we focus on this metric, it correlates to dividend safety and balance sheet strength. And as we can see, 1.58 in 2023, expected to go lower over the next 12 months. So their balance sheet does look fairly decent. The dividend also looks to be okay, but the one red flag indicator from this company is the very high free cash flow payout this year as well as expected over the next 12 months. Now, before we continue, we also want to let you know we have released our latest free weekly article as well as a paid version where you do get access to spreadsheets and undervalued companies. If you want access to this or any other articles, you can click on the pinned comment below and you will be able to sign up and read straight away. What we also like to do on this channel is look at insider movement. Now, the percentage is around 0.13, and we do note around 4 million worth of selling over the last 12 months with very minimal buys over the same period. But one thing to note, if you do want to look back at when the last buy and sell was, the last buy was more recent, 200,000 in quarter 1, and the sell you would have to go to 2023 quarter 3. We do typically like to show who these insiders are, bearish or bullish signals, but as we said, they are pretty much outdated, so nothing really to discuss, but you can see the information clearly here. We then take a look at the ownership institutional wise, 60.3%, 7.5 billion worth of sales over the last year, with marginally more increasing or a fair amount, 11 billion during the same period. And what we note in quarter 2, a very similar amount of buys and sells. In the previous quarter though, we do get a lot more selling. One thing that we do want to really highlight on this channel, whether insiders, institutions buy or sell, always do your own due diligence, never copy someone else's trade. Now, what we also like to do is have a quick look at the income statement as well as the balance sheet. And as we've already gone through the revenue, we just want to show you that over the longer term, we did see they have been increasing their revenue. But bear in mind, with a company like UPS, you're not going to get massive increases to their top line year on year. At a minimum, you want them to keep up in line with inflation. So what we want to take a look at here then is their bottom line net income. Is it a similar story to their top line revenue? And what we in fact see, they've more than doubled their bottom line, 3 billion in 2014, 6.7 billion in 2023. But when we do look at it on a more year-on-year basis, very inconsistent. In fact, it has peaked in 21 and started to decrease. So a few elements with this company that you need to think about before investing. And as always, we will look at a margin of safety as well before we see what our buy price would be. We then look at the health of the company, total cash versus total debt. 3.3 billion of cash and short-term investments in 2014, 4.5 in the latest quarterly report. So it has increased over the longer term, but we also see a little bit of inconsistency year on year, which is fine. Ultimately, we never look at this number in isolation. In all honesty, that just wouldn't tell you anything, just one number from a balance sheet, which is why numerically and directionally we compare it to their total debt, which has more than doubled from around 10.8 billion to 24 in the latest quarter. And as we can see, it has been trending upwards over the longer term. Something to consider, but when we did look at the dividend safety, for now, unless something massively changes, it does look to be safe. Then we take a look at how they've performed in their previous quarters. Now this hasn't updated yet, so what we can in fact notice over the last 4 quarters for UPS, they did in fact beat quarter on quarter. Ultimately quarter 2 of 24 they have missed, and therefore it's even worse than the negative 22% they were expecting year on year. Over the next 3 quarters though, they are expecting an increase, but let's see whether or not they do also change their earnings per share guidance moving forwards. Now if they do hit the EPS estimate, and again whether or not you have confidence in their forecast, the forward P will be lowered down to just below 15. We then look at some gradings, and the first one is the valuation. Now as we mentioned, the P on a non-GAAP basis is now down to around 15, which is significantly lower than the sector median. It's not been fully updated yet, but ultimately in any method that you use for valuation, or we should say the majority of them, they are looking like they are trading at a discount to the sector other than the price to book. Now as always, a company will be trading at a premium or at a discount or in line with the sector for a reason, so we need to understand whether or not we have spotted something that maybe the market hasn't, and we should be looking to add this to our portfolio. Or in fact, whether or not this negative 12% in your own opinion you do believe to be an overreaction on a company that not just at a new 52-week low, but also giving a yield of 5%, and that is sustainable. We then take a look at some growth metrics. Now year on year, negative 9%. The sector as a whole, mid-single digit. Over the next 12 months as well, negative 1%. Again, we can see one reason now why, in fact, even if it is trading at a discount, there are some concerns over this and some justification and probably warrants why it is trading at a discount. And one of the things we also like to draw your attention to, the earnings per share growth over the next 3 to 5 years, 8.2%, with the sector looking a lot better at 11.5. Then we move on to the final one, which is profitability. Now they do get an A+. Bear in mind their gross profit margin of 22% is lower than the sector of 31%, and when we do look at the bottom line net income of 6.6, it is marginally better than sector 6.1. The final thing we will draw your attention to, probably why they do get an A overall, is their cash from operations more than 11 billion, whereas the sector 328. So as a quick overview of this part of the analysis, a double buy rating, a hold from quant, B+ on valuation, D- on growth, and an A+ on profitability. We then want to take a look to see how they've performed against others in the industry, whether or not it is a trend or something in isolation. We have FedEx, Deutsche Post, as well as a few well-known others. And when we look just over the last year, what we do note, including reinvesting those dividends, UPS has been the worst performing. However, what we can see, the trend is, other than FedEx, every single other company in this industry has had a negative performance. When we expand it to over the last 5 years, we still see UPS as one of the worst performing, but the majority of them around a 50 to 100% total return. And when we expand it to over the last 10 years, we can see it has been one of the worst performing. Now, over the last 10 years, a 69.65% return isn't that great, but it doesn't mean they'll perform that over the next 10. It could be significantly better if you do believe it is undervalued in today's market. The one question you always need to ask yourself before investing in companies that may be looking very poor over a historical period is, will it outperform the S&P? No one knows the answer. It is the future, but the main thing is, do you have confidence that they will? Otherwise, reality, what is the point in investing? Yes, the yield might be slightly higher, but overall the total return of the S&P, if you believe it to be higher, no point in wasting any time. So UPS, as we can clearly see, no surprises here. When we do look at it over the last 5 as well as the last 10 years, we can see that it has significantly outperformed. Now let's move on to the essential valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of the videos as they drop. Now our intrinsic value of $151, we put it through 3 models. The first one, multiple valuation, companies in a similar sector and size, their P multiplied by the EPS of UPS, to give an intrinsic value of $152. So that was a signal of undervaluation. We then put it through the dividend discount model. Average growth, nice at 12.5, but we can see the last year was very, very low. So we have a 3.5% growth rate moving forwards. So another undervaluation signal. And then we put it through the DCF model where we have the free cash flow year on year. We have the growth rate at 8% with the discount rate. And then we got to the present value of future free cash flows and terminal value. Added with the cash, subtract total debt, divided by the shares outstanding, and we get a triple undervaluation signal. So that is how we got the makeup of the $151. Also note, Wall Street's target isn't dissimilar over the next year. they do see 18% upside, and what we always do on this channel is we run it through a MOS level. Now also remember, you can grab a copy of this model by clicking on the pinned comment below and running in your own numbers, whether it's for UPS or another company. So at the 10% MOS, which we use if it has 3 criteria, a wide moat, strong financial metrics, and good forward-looking data, then again you can see a buy up to $136. Then we go until it hits the current trading price, and pretty much at a 15% MOS is where it is trading in today's market. So it has a 15% margin of safety, upside of 18% per Wall Street. But as always, do let us know your thoughts in the comments below. It is now trading with a yield of around 5%. It is at its new 52-week low. Does this make it attractive for you as an investment? My personal thoughts, for me, this is definitely not one I am considering. Look at the metrics when we ran through. A lot of them were very, very poor, and it isn't one that I would be looking to risk. There are many, many other high quality companies that are trading at undervaluation status or even at a fair value that I would rather put my money into. If you want to see what those are, do go check out the newsletter. As always, let us know your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.